Welcome back to channel everyone. Today we are diving into one of the biggest question of every trader mind. Is the Fed cutting the rates by 50% or 50 or 75 basis points? And in 1 minute, in 36 seconds, this is the data is coming out and we will be watching it live over here. And actually they are going to be cutting 25 points live over here, and in a couple of seconds coming out. We will be breaking everything exactly down here, how this decision kind of sets the tone for the markets, what it means for crypto, and how the fear and greed dynamics are shifting traders position for the next and also we will be watching another guy who is commenting at the Fed, who has been watching the Fed decision for a while and understand each wording of the Jerome Powell and what this means. Sadly, right now, I'm not able to share my camera with you. Some technical issue, please forgive me for that. And we'll be checking that soon enough. Right now, this is 0. And we'll be checking right now the Fed decision. Before that, we will go straight into the meetings and highlighting, covering, and moving what is. So over here on the website, it's always great to see the projections. The projections are always happening over here on the website, but the most importantly is we're gonna go into trading view over here. Right now, I'm gonna be sharing with you my trading view. So let me.
Fed thinks stronger economy, slightly higher inflation, same core, and then slightly lower rate.
Here, so
you're at 75 basis points for the end of the year.
Exactly.
So 75 is the answer. So they cut today, and now they're pricing in another set of cuts right now. Ooh, gold is getting clobbered.
So
that was a weird one, but look at the bonds right here. What's your problem?
Right,
I don't think it's credible. No. Look, bonds did a pop and lock, and gold is dropping.
I have a couple of colleagues right now
this
on
is
Discord
the
also sharing the live streams. We have all the flow
like I'm telling you, the Fed just said one more cut.
And if you have any question or want to share it with me, please do that.
I didn't even read
right now we have
I went straight to SCP.
1 minute. I'm not right now in any trade, so I have hedged the market already today in the morning. And the projection for the year is remaining the same, and the Fed conference is coming in 30 minutes. We're gonna be watching that also, but let me make that guy bigger in terms of what's going on with data.
How about a bus
the key important data over here.
Recent indicators: growth economy is moderating, unemployment has edged up but remains low. That wasn't even that good too. So the statement wasn't even that dovish. They said unemployment edged up, but is low.
Holy fuck!
We're gonna downside risk to employment have risen. Two soft mentions. It's two soft mentions of whatever. All right, I think that was a little credibility dip, but equities are going.
My colleague over here
it's
is saying
IWM, my
we're gonna
friends.
rip.
Take notice.
So he's pretty
I think IWM is the first winner for now. If that could hold up without a dip before Powell,
on the stock
that's
market.
A good sign.
Let me check if it's nothing changed. Usually it doesn't change.
But yeah, the statement wasn't
hourly
as dovish.
basis.
The only thing dovish was the
GDP, same for the fear and greed,
and then an extra quarter point of cuts on
side,
the
53
on the terminal.
Has been consolidating for the last.
But they weren't as strong with how they mentioned it in the statement.
Bullish, right
all they said was it edged up but remains low,
waiting for
and then downside risk to employment has risen. That's not as aggressive.
And the market is moving, and of course when it's coming to those hours of the market, never traded live in terms, always many platforms, even brokers, prohibits trading in
Moran
the
was
Fed
the only
decision, FOMC, CPI,
so you have a little bit of spread between the dots,
important, such as
that's fine.
PMI
so
also.
I'd chop it up slightly more bullish, bro.
More purchasing management index.
All you got to do is credibility.
So what you want to do is
watch out. If they want to flip it on you and say no, Fed
let's
can't do
switch
that,
to another
it's going to
screen,
cause
which is
inflation.
giving us more
so if
better
people start
overview.
saying inflation,
First of all,
this shit's going to stop. But if they don't bring up inflation, it's going to keep going.
In the next overview,
I hope that makes sense why. So think about it.
Check also if
so like I'm saying, you got the extra cut though. I hope you're seeing it, and the Fed thinks the economy is up. They have acknowledged the lower labor market, but they are not that scared of it.
So you hear that?
So that could be less credible if inflation comes up. But if inflation doesn't become a problem in the next few weeks, days, months, then you just got an extra cut, slightly more dovish. You just need Powell to verify it with his presser. But yeah, you're ripping, man. So GG, those IWMs. Remember, we already positioned for this, so I was reading and doing all that shit, but oh yeah, we in there like swimwear. Oh, they didn't even move those though. So out of the money cheapies did not work.
So the market
oh wait, now they did. What the fuck is happening?
The hedging.
All the premiums are just tweaking. But yeah, not as good. You could go for a double dip on gold. Otherwise.
So right now we will be not taking any decision as the volatility poorly is the volatility the same for the gold.
Whoa. Why did K-Web launch up?
Pumping. We were expecting that volatility, and when we look at dollar is just dying. But before that, because the most important thing was looking at this chart over here, and it has been shared by another trader, the FX Revolution guy. He shared this chart. If you want to, you can give him follow. But before we continue, it's very important to keep in the mind this disclaimer. All content I'm sharing here is educational purpose only. It's not financial advice. Do your own research. And nothing is fixed. I don't know what's going to happen in the future. I never knew.
You're going to rally until inflation risk
only
comes
the probability
back.
of
I
it,
think that's
right?
the
So right
simplest
now
way
this
to
is
say
just
it.
the alerts going.
Because
so
as long as there's no inflation risk,
you're
going to keep going up. And that'll allow TLT to climb.
What a crazy move.
And everything else. But otherwise, that's kind of the error.
Over here.
Yeah, they're just widening the spreads on everything.
So they were just waiting for the market, right?
So if it has a good bid, you can take profit. Otherwise, remember the pressure.
The dollar index was like, okay, double down button. So I would expect if we're gonna drop today, okay, if we're gonna drop today, it's gonna be from here with double down on the channel of. Let me reduce the noise on my chart so you understand what's going on. And let's go to the 4-hourly. So I was watching this double down on the dollar index over here on the left side. So we have already started the whole move, and right now we are retouching this. And if it's gonna happen, reversal, it should happen around this area. So yeah, and let's go back to our chart. So basically this chart is stating it's gonna be the first 2 months of the market, which is after a cut. It's always a small correction happens in a market, right? So a small recession, we call it. And which is likely to happen. The first 2 months is bearish for the markets, as we have seen lately. The insider selling over here, when we watch the insider selling, is there has been selling very quietly last week. So it is very coinciding with this chart over here, and we will be digging deeper into it. And after 2 months of the cuts, the first cuts, which is today, happened in 30 minutes.
It's just the same story. That's all. You got the same exact
Chairman
setup.
Jerome Powell is going to be coming out and telling
point,
us what's on his mind and what's he's thinking,
but
right?
So
yeah, so the first 2 months is bearish, then after that the markets recover very fast, and is for the rest 6 months is very bullish. So which is mean for us is an opportunity for doubling down and hedging ourselves and shorting the markets. And the idea is when the VIX, always the volatility index, it spikes, which is suddenly in our case not so, it's just dropping. So it's meaning people are de-hedging and going into more riskier assets, such as stock market, right? And when we watch that, and it is very important to keep in mind, volatility index is calculated based on the 30 days upcoming future option implied volatility, and we call it the VIX index, the volatility index. The treasury bonds is also a hedging mechanism like gold. When you watch both of them is going higher at the same time. Right now the S&P 500 going lower.
The 490, give or take, but Powell could change that. I wouldn't be too set. I think it's cool. You got a nice little quarter point surprise on the dot plot and all, but other than that, I don't think
let's keep it in mind
really
also,
changed.
right? It's very important we keep it also in mind. One thing over here, it is the Bitcoin pass, right? The altcoin season when it's coming. So first of all, the Bitcoin, the money flows into Bitcoin. Then after that, the Ethereum, which we saw clearly over here when we go over here to Ethereum, USDT. Let's go to more the weekly view, or let's do it daily view, and zoom out a little bit and decrease over here the noise. So yeah, we saw very clearly. I was watching over here the market for potential hedge, and it exactly happened. And over here I was looking for a second hedge because of the money and liquidity shift on Ethereum. And as we see, we did double bottom liquidity grab, and we are right now over here consolidating. And always is the question: it's gonna be higher or lower. So I was expecting to go lower to retest the bottom of 1,500, and then reverse again. And it's kind of wave pattern consolidation, but a larger wave over time, right? So right now, what is going on is wanted us to show you it is how Ethereum has already pumped, right? In our case, Ethereum has already pumped over here when we watch it over 200%, and which is was crazy since 2025 April, and it is not long time ago. So the money is flown to Bitcoin and then Ethereum, and next it is going to Solana and other large caps, the top 10 majority of the time. So let's check another alert is going on, which one was triggered by ES, right? So the ES alert, we're gonna keep this one. Let's go to the 60-minute. Let's go to the 15 minutes. On the 50 minutes, on the left side, always I have chat open, not the chat, the documentation. Commentary always on the right side, what I think and what's going on. So today I was in this short and I closed it half an hour before the FOMC decision making, because I was thinking, okay, if it's the market gonna drop based on our chart over here, then it should happen in that scenario, right? In exact that scenario. So I was thinking in my mind the probability and also a setup which could potentially play out. But I don't trade on big economic indicator because majority of institutional player, they are all hedged and out of the markets. So we want to keep that also in mind. And I was watching one other thing over here is very important, is watching the small cap. Based on our analysis, the small caps is takes the majority of the time to recover from such as recession, which is at least 2 months after the first cut, which is today happened, and was looking for TZA because I saw a couple of White House politicians and Congress politicians were longing this TZA, which is betting on the market short. When the market goes shorts and losing the small caps, this index over here, this ATF just skyrockets by 3x, and exactly a couple of congressmen betting against the US economy over here, and for that I was watching it. So yeah, that's being said, those red and green levels which you see is limit orders, where a majority red means sell limit orders sitting on the chart, and the blue ones means always that buy limit orders is sitting. And second of all, when we watch over here, it's very important to understand I have another indicator which is called liquid edge, developed by me, understanding the liquidity flow in a specific chart, working with every volume charts. You can ask me in the comment more about it if you are interested. So basically, when it means reaching 80, where it is increasing and potential bull and potential bear signals giving you, which is not indication of buy or sell, it's just telling you potentially where the flow of liquidity is going, and you understand, okay, it was it accumulation or distribution, which is telling you the bottom and the top of the market. So majority of time, we all know, we see those zigzags pattern. The market moves down and make a zigzag, right? And then you want to know it's going to go lower or it's going to go higher, right? So that's exactly the indicator down below, is the liquid edge, telling you if it's going to be accumulating or distributing. The same upstairs, you want to also see this pattern. You want to know it's going to go higher or it's going to go lower, right? And the same, the liquidity indicator over here is telling me. So we say the fear and greed is remaining same. Tomorrow is going to tell us a different story, because the risk right now is still neutral base and not that a lot of risk in the option markets. But when we watch the economy today, the housing and other pyramids which was building, let's watch it on the trading view side. So if you are now just joining the live stream today, we're covering the Fed decision and also figuring out what's the market direction is going to be and what I'm looking for and how we're going to be trading it and positioning ourselves. Currently, I'm in a hedge position. I'm waiting for reaction in 50 minutes from the conference of. So, from the conference of. From the conference of the chairman Powell, Jerome Powell, to tell us where the market's going. So we said Bitcoin large cap, it's gonna be the next move, and then alt season, and majority of the alt season is coming in December. I think who said that? I think a woman over here was Noel. I think Noel, was it Noel? Novel, was it Novel? Let me check it. Okay, Novel. So doesn't exist for whatever reason for right now, doesn't matter, but we can see clearly over here, wow, this is fucking sorry for slurring, but is going very volatile, this stock over here, the Chermos company. And when we watch the Chermos company over here, go to trading view and type it over here, you can find the ticker and information of those companies over here, and go to the overview and you check it out, and we can see the key sector where they are operating. I'm already invested in it. It is called the chemical specialist over here, and that's why the alert is going over here. So why the only thing was concerning for me the debt ratio and the free cash flow, and despite that this has been pumping and the annual basis also, and we had last time 2024 almost $1 billion in investments. And that's a chemical company, so you know the background of it. Let's go back over here and see what's going on with the market. The bond market is just exploding, okay, and Nasdaq is just recovered based on my analysis, and Nasdaq has been overvalued by extremely by the institutional flow. Is just shifting from the side of buying into selling slowly, and has been in a sell side for a while based on my analysis and my indicators. And of course indicators is always lagging. A majority of people don't understand about indicators. They are lagging, yes, correct, but when you look at that bigger picture, right, if an indicator telling you on a daily basis information and you aggregate those information, you can get a time frame, rolling time frame information, which just means what's happened in this time frame, the last week time frame, the last month's time frame. So people are not shifting the money in seconds, they are shifting it in time frames, right? They cannot sell everything at once, they cannot buy everything at once, and that's why I developed the liquid edge indicator over here to tell me what's happening in those time frames. So Bitcoin is still at 15K. It is fighting for its lives. Is it gonna go higher or lower to another level? When we go to BTC, I'm watching it at the bottom of our parallel channel, right? It is already, we took that long and was expecting over here to see correction, but didn't happen. And it was like majority of the times the correction happened upstairs there. Right now we are at the bottom of the parallel channel almost, which we need to retouch it or go to the VWAP, the volume weighted average price, which is telling us what is happening, where the institution want to enter, right? So the VWAP is this very powerful tool, institutional player using it, which I'm gonna be teaching you in upcoming program, which I'm launching soon enough in January. The first students gonna be joining us. 5 seats, 3 quarters. I'm gonna share it over here with you so you understand exactly what I'm talking about. Again, remaining the disclaimer, educational purposes here. So I need to be very careful with what I'm saying. So SEC and CFTC regulations complying. So let's watch it over here. So I've been building this institutional grade trading system so you can understand it for basically all traders going in the same process, right? So we all start somewhere by realizing signals, hype, chasing indicator, no structured emotional trading, just going into the markets. And there is 4 levels of the being a trader. The unconscious incompetence, conscious incompetence, and conscious competence, and unconscious competence. Basically said, we are starting from the level we knowing nothing and we think we know something, and then entering and trading and losing money. Then the next level is we know we don't know it, despite that we entering the market. And the third level is I know what I'm looking for, I know how to get it. Maybe I need some extra help to become a more unconscious, competent trader, which is like I don't think about trading in terms where the indicator are, what the trade and setup is. Just like I have my spreadsheets, I have my Excel sheets, I have my system, which is repeatable. I just do my system without thinking it. When I see pattern without thinking it, I know what's the market direction is going to be. And the pattern recognition is a very important part of trading when you come to that. And at the end of the day, majority of retail traders or people out there is just lacking the information, the guidance to become unconscious, competent trader. And that is very easily said, and simply the reason behind it is that there is a lot of conflict of interest. The broker don't want to tell you how to trade, otherwise you're going to be making money and trading less, so he have less money through you. The educator will do the same, and other player will do the same, so they are profiting through you, the volume you trade, the frequency you trade, and taking those fees and losses and distributing between themselves. This is a big mafia organization worldwide. If you don't understand the business model of something, how the rules are, you will never know and know how to win. So that's being said, this program I exactly built it for professional, busy, serious, focused operators who want to really seriously improve their skills. Not just another signal type indication, buy here, sell here. It's these telling you how to think and trade and behave like a real investor and trader in the market who is on the Wall Street. So what I'm giving you over here is this system to understand the market, and also checklists and risk rails to execute and behave like a real trader and understand your risk at any given moment. So execution packages also in it, decision trees, tools, implementation, everything I have built in the last years and over 10,000 hours of trading in the market. So the program itself is very simple. Before the Fed decision starts, we're going to be going through this also. So in 8 minutes, is the Fed Jerome Powell is coming out. So we will be going through the program, which I have been building rigorously in the last months for you guys, or to be exact, in the last years. My sweat, my blood, my time, my energies all went here for you guys to give you something special more. So we're going to be assessing the foundation assessment and also understand where the problems are. Then we're going to improve those problems and give you rules and structure to prevent those problems. And of course, do you need to be a trader to join this program? No, you don't need to be a trader to join this program. It is everyone. It is open to everyone also who want to seriously improve. So that through the time we will be understanding also how to execute trades in the time structure, liquidity analysis, and more, as I've shown you on my charts a little bit. Technical analysis is going to be part of the analysis, but it's going to be not all of it. So fundamental, technical, risk management are the most important things. We're going to understand the formula of win rate, risk reward ratio, and drawdowns, and so you understand how the Wall Street operates, and everything, of course, transparent. I'm not taking everyone in this. I'm taking only 5 people per quarter, and the rule is you follow journaling, you follow my rules, which gonna be giving you and doing 10 unassisted sessions yourself, and then we will be improving everything together also. So my background, as I say, 10 hours, 10,000 hours in the market, tested hundreds of strategy, building hundreds of strategy, reviewed hundreds of setups, back tested them. And why I'm building this, my story basically said I grew up in Syria and lived through a very sad war, and because it was war over there, and then I went to Turkey to understand the meaning of the work as a child and understand the hard work, and it's only through discipline and resilience and a lot of work and sweat and blood I became a profitable trader. So yeah, of course, you can go over here and download even my framework, how I understand the market and how I trade. My 4-step framework is gonna be also live over there, and of course, you can compare us to with other traders and make sure I'm giving you the best services for the best buck. So when you go to Proof Hub and Comparison Hub in our site, right, so you will see clearly how we collect data and to prove it, and how it is exactly shown over here, and you can even show the matrix, how it's being calculated, when it's being calculated. So basically I'm telling you weekly, sharing you with my journal, if I followed my journal, how the customers thinking, if there were rule breaches, if there are commentary, and so more. So even on the monthly level, on the quarterly level, and yearly level, you understand where I'm standing. Also the certificates which I got, and what does it mean, the all screenshots I have from my trades from the crypto space, also ton of it over here to prove it. And most importantly, it is anti cherry picking, so I'm not picking anything. You can see clearly I got some losses also, but majority of the time is the risk reward ratio, right? So how much I'm risking to get how much, right? And also over here a couple of other third party verifications in term trading view and more. And we will be getting also a couple over here, some reviews and how to verify those reviews. Also on LinkedIn you can verify those reviews. The most important thing is over here also to compare us with others. So I have developed a concept called the red flag index, right? And the red flag index is very simply understanding each mentor courses, programs, and giving them scores based on the proof of transparency, deliverability, risk education, pricing honesty, guarantee clarity, capacity honesty, marketing ethics, and support structure, right? All those type of things is going to be scored between 0 to 2, but I went even further and made already a table, a comparison metric between all the YouTubers and everyone there. I didn't mention their name because don't want to get in trouble over here. Just say it mid-tier ticket, low cost community, and high ticket. So I have already done the analysis for you so you understand what you are getting for your buck, and even went deeper into my analysis and compare it to the more charted financial analysts and charted market technician, and to understand where I provide value more than other for your buck. Majority of them cost between 10K to 30K. Even the quant finance one over here, right, is taking a lot of time, 6 months, 12 months, and of course a lot of money also. So yeah, basically said, doing that for you, and the indicator over here, which is called the index, the red flag index, you can download it basically over here. And it is very simple. Is this working? You come here, you put the score for each other provider based on those things, and you understand what does it mean. And in the dashboard over here, it's going to show you the numbers, right? And also how to calculate it in terms of what the numbers is meaning. You're giving each one a score, right, from 0 to 2, and how those 0 to 2 even simplified for you so you can understand it and even compare it, right? So you just go over here when it's coming here, go over here in the download and download it, and you on PC, and so you understand exactly what the thing to do, how to even verify each mentor, verify each information, and the most importantly is to do your own research. And that is what I'm trying to teach everyone: become independent, conscious trader. And I think a lot long monologue I have done over here, and shortly will be watching a guy on YouTube who is doing commentary on Jerome Powell, understands his wording and what's his meaning by it more than me. And I think that is one of key important things in trading, to let other who are more advanced than you in a specific area to guide you through it. The same with my program. I think I have talked a lot, and let's go back and check the market, where the market is and what is doing over here. As I said, a lot of volatility, up and downs. We don't trade that. A lot of people got liquidated who thought this market gonna go up. A lot of people got liquidated who thought market gonna go down. So we're just watching. As we said, we are at right now at the dollar index. When we go back to the dollar index over here, right, let me close all those information. Again, the journey of a trader, you can make a screenshot of it and or pause the video, and I'm building it for you, and more information about me is going to be also in the mentor section over here, right? Who I am, what I'm doing, and so on. You're going to find it all over here about me also. Let me close all the unnecessary windows over here, even the red flag index, and this is my, let's close the economic indicators and the fear and greed. We have already analyzed that. And we said what's going on with the company over here. So the idea over here is we have explained that also, but we're gonna go deeper into DXY. As we said, when we go to the 1 hourly, is it's gonna be correcting itself. Very importantly, okay, Jerome Powell is on, and we will be watching him right now.
Mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year
Has he
and
always said housing is weak?
1.8% next year,
Because that's good.
a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August,
I
but
don't like
remains
that.
little
He said
changed
edged
over the
up.
past
Yeah,
year
little
at a
change.
relatively low level.
That's not good.
Payroll job gains
don't
have
sound
slowed
too scared
significantly
by
to
the
a
labor
pace
market.
of just 29,000 per month over the past 3 months. A good part of the slowing
he made
likely
sure to know
reflects
you
a
said
decline
edged.
in the growth of the labor force
That's not the wording
due
you
to
wanted.
lower immigration and lower labor force participation.
That's what I was
Even so,
telling you before
labor
this
demand
came
has
out.
softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market,
What? Somewhat
the downside
softer.
risks
I don't
to
like
employment
that.
appear to have risen.
Yeah, that doesn't sound as dovish.
In our
dog.
SEP, the median projection
not
for the
really
unemployment
saying
rate
it's-
is 4.5% at the end
It's
of this
weak.
year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August. and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services.
So that's the inflation
Near-term
mentioned.
measures
That's
of
not good
inflation
either, but
expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level.
Still saying that.
But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed.
That's what I'm saying.
Our
That's the
obligation
inflation,
is to
the
ensure that
credibility.
a one-time increase in the price level does not become an ongoing inflation
Softer
problem.
mentions of labor, harder
In the near
mentions of
term,
inflation,
risks
but
to
then give us
inflation are
another
tilted to
cut.
the upside and risks
It
to
just literally
employment to
doesn't
the
make sense.
downside. A challenging
That's why you've been getting
situation.
these reds. Softer
When our
labor,
goals are in tension like
little
this,
bit of inflation talk.
our framework calls for us to
Not
balance
nailing the
both
coffin,
sides
though.
of our
Don't
dual
panic.
mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy
He's
stance.
explaining it.
With today's decision, we remain well positioned to respond in a timely way to potential economic developments.
Timely way.
We will continue to determine
Yeah,
the
they're gonna
appropriate
react at the
stance
last
of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course.
Yeah, TLT drop it now.
The
So
Fed
by
has
the
been
time you
assigned
heard
two goals
inflation-
for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans.
I
We
know. I tried
understand
to
that
turn
our
off
actions
the
affect
music. I
communities,
accidentally banned
families,
you
and
instead.
businesses
I
across
don't know
the
how to
country.
do it.
Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability
He
goals.
starts talking communities
I
and
look
ends.
forward to
Oh, he
our
didn't end it with
discussion.
DEI. All right, Chris Rudebar, AP.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Myron has continued,
Ooh, drama.
kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic?
What a dumb question.
So
what a waste of
we
the
did
first
welcome
question.
a new committee
It's
member
been a
today,
year since
as we
they
always
cut
do.
before an election,
and the committee
you're
remains
talking
united
to
in
me about
pursuing
Fed
our
independence.
our
I'm
dual
going to
mandate
talk over
goals.
Powell. That's a stupid fucking
We're strongly
question,
committed
reporters.
to maintaining our
Chris,
independence,
I
and
knew
beyond
Chris.
that, I really don't have
Come
anything
on.
to share.
Ask him about inflation.
You and other Fed officials have spoken extensively about the impact of tariffs on inflation.
There you go, Chris.
Although perhaps with many
Fucking
companies
idiot.
appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead.
Yeah,
Do you see that as
I
a
don't say
possible outcome
nothing.
here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
He's a pretty funny guy, I think, when it's coming to
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices
listen, this is gonna move
accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point.
You said all of the
and we do
inflation this
expect
year
them
is goods, no services.
to continue to build over the course of the rest of the year and into next year. And you know, it's also possible and that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply.
But he's doubling down. The labor market slowness is
to the point
immigration.
where we see what I've called
But
a curious
keeps talking
balance.
like
It's,
tariffs are
typically
going to
when we say
cause
things are in balance, that
inflation
sounds good,
like
but
that.
in
That's
this
the weird
case, the
part.
balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
That's not good. He didn't say it, but he's kind of talking about
Nick Timmerosa, the Wall Street
like
Journal.
a spiral.
Chair
He's
Powell, do
saying the
economic
supply
conditions
dropped
and the
and so did
balance of
demand.
risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able
God
to
bless
do
you,
that
Kyle.
over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality.
good.
We don't need to know that.
That was his
But
first good
we do know
comment
that
on inflation.
They've moved meaningfully toward greater equality, the risks between the two goals, and that
But he's
suggests
still
that we
playing
should
the
be
fucking
moving in the
barbell,
direction
both
of
sides.
neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right
But
thing
you
so
felt
far
that
this
way
year. I think
before
we
the
were right to
election
wait
then, you
and
dickhead?
see how tariffs and
So
inflation
he just admitted
and the
they
labor market
expected a big
evolved.
shift ahead of
I
the
think we're now
election. That's why they cut by
reacting
50, but won't do it
you
now.
know, to the much
Fucking
lower
idiot.
level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not
They're
fully
gonna
balanced, but
they'll
moving
make
in
an
the direction of
article on
balance
that.
now, and so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut
Okay,
as the
dollar's
committee
going
taking
up
out some
now. That's
insurance
bad.
against the possibility
Now
that the
this is
labor
gonna
market is at
backfire.
risk of weakening?
Bonds and
or is it
dollar
the committee's view
going
that the
reverse.
dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more
a good
cuts
question.
than just
He's
3
asking
months
if
ago,
3
with
cuts
the fact
leads
that
to
the
a
forecast
recession.
for
That's a great
unemployment didn't
question.
change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the
he's saying,
SEP,
don't overthink it,
actually,
risk management.
the projections
Interesting.
for growth this year and next actually ticked up just a little bit.
That was
and
a great
inflation and
question.
unemployment didn't really
Give
move.
that
So
lady a
what's
promotion.
different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's
That's
time
the good.
to,
He said really
to take that
cooling
into
off.
account in our
That's
in
what
our
we needed to
policy.
hear in the beginning. Every
The
other
SEP,
time he-
once again, the median participant has
cautioned it.
inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so
Okay, you're plummeting.
I would look at it this
Dollars
way.
up, bonds are down.
We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address. How do you see
Good question, Michael.
as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
I can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened, so the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation, how do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier
Oh shit, I was muted. Did you guys hear what I was saying on
labor
clarity?
market, there would be jobs for those people. But
That
now
was
the
his
hiring
best
rate
answer
is
right
very,
there
very low. So
when he was saying,
that's been a growing concern over the last
that
few
the
months.
inflation outburst
And it's one of the reasons
is
why we
lower
think it's appropriate
and labor
that we
risk.
begin to shift our policy focus.
Very interesting. Oh wow.
Toward a more balanced one.
Oh, I was muted. I was saying that was the best answer right there. He finally said
Steve
if the
Leisman,
risk of
CNBC.
inflation is
Chair,
lower,
in the
but
past,
the labor market
during rate
risk.
cuts, you used the word recalibration.
That's the part where everybody,
I
Wall Street
wonder
thought
if you
labor was a
pointedly
lot
did
worse.
not use it
Powell's
this
saying
time.
no, but then
And
he's
in fact,
saying
when you said
inflation isn't
policy
that
is
bad.
not on a preset course,
That was
did
the
you mean
first good
that
comment.
is sort of the opposite of
But now we're back
of
down anyways. But
recalibration.
I'm
Are
writing
we,
these down.
Meeting to meeting, data point by data point, are we in the process here of getting back to neutral? Thank you.
But yeah, I want a stagflation question.
So I think we're
really
in a meeting
prepared.
by meeting situation. We're going to be
It's a
looking
very
at the
weird one.
data.
But that was
You
your
know,
best
let me
answer
say a
2
word
minutes
about
ago.
the
I wrote it down
SEP
for you.
really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you gotta be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that, but it's also partly about what's the right thing to do in light of this, of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico.
Oh, she switched.
You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what
Another
exactly President
Fed-
Trump's intentions are with the Fed,
That's
what
why you
would
don't work at New
point
York
to
Times no
as
more.
the things they should be watching
You shouldn't even
to
work here anymore.
determine
Our
that the
trade
Fed
is
is still
working just
making decisions
perfectly.
based on
So sadly, we don't
the
trade it
economic
because
The
outlook
guy
of
is
the
just
political
making up
independence.
answers to do what he wants. He's
Look,
not.
it's
What do you
deeply in our
mean?
culture
Look at
to
political
do-
independence.
to do our work based on the incoming data and never
This
consider
guy
anything
just
else.
said
That's
inflation's
everybody
not
here is
going
at the
up, but he's
Fed
worried
really
about
feels
inflation,
strongly about that
and
way.
labor's
So,
going low, but
you
it's
know,
only slightly, but
you'll
it's
know
so
it
low,
by the way we
demand's
talk
low.
about what we're doing, by
mean
the
politically
speeches that people
independent?
give, by the decisions that we make. You'll know that we're just still going to do that.
I thought
That's
he
all
was
we
going to
do.
come out honoring Charlie
And
Kirk.
we don't frame
That's-
these
you
questions
want
at all
political
or see them
independence? Get the
in,
fuck outta
in
here.
terms of political outcomes. I think when you get to another part of Washington, everything
low.
is seen through the lens
Dollar,
of does
though,
it
dollar
help
and
or hurt
bonds.
this political party, this
I have it written down,
politician,
bro.
you know,
I'll
that's
explain
the
more of it.
framework, and I think
But
people find
remember,
it hard to
everything
believe
still
that that's
stays the
just,
same.
that is
Next
not
couple
at
days
all
are
the way
key,
we
you
think
guys.
about things.
I don't
At the
think
Fed,
I'm
we're
wrong
taking
on
a
anything
longer
of this. It's
perspective.
just price action,
We're trying to,
Powell's
serve the
pretty
American
shitty
people
today.
as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. You know, I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having really a great discussion around these challenging issues. So
Do you see the court case around Lisa Cook as being related to questions of Fed independence?
you know, I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions
Let's
for
see.
June were the first negative revisions we've seen since December of 2020. You know, how can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor
He just
Statistics really
said,
does
bro,
understand this.
they're
and
not
working hard to
surprised
fix
because
it.
they
It's got
priced
to
it
do-
in.
Of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model.
A predictable
Because a good
overcount.
amount
He
of
is
job
going. The
creation
birth-death
happens
model does make
around
sense,
new
but
new
come on,
companies,
Powell.
how many go
First
out of
TP
business, how
over
many
here,
are founded,
and it's
and it's just
going
really
down.
hard. You can't
So let's
survey
see
for
how
that.
it
You've got to
reacts.
have a model that predicts that.
That's funny.
It's quite difficult to do,
Because
especially when the
prediction
economy
is
is
great
undergoing big
or-
changes.
you guys
So-
are just
and
like,
let's
they've been
create
working
the
on that and
credibility.
are
What if
making
all the data
progress
is
on it,
fake?
but
Well,
the
actually, we
data
priced
get
that in. It
is-
was a
is
very
still
predictable overcount
well good enough
for
for
the
us
last
to do our
several
work.
quarters. He meant to say the
To
last
the
4
extent
years.
we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. You know, we want higher response rates, and we need those to have
It's no great
less
secret.
volatile data. And the way to get that is to make sure that
What about
that
consumer
the agencies
sentiment?
that collect the data have sufficient resources to drive
Tell me about Michigan
higher
consumer sentiment,
response rates.
Mr.
It's
Powell.
not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
For the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had that information, would it have changed your mind related to where the interest rates should be?
wait a minute.
Should there have been a cut earlier?
Does that mean
we
there's
have
an
to live life
overcount
looking
now?
through the windshield rather than the rearview mirror, as you know. And,
Wait a minute.
All I can tell you is we see where we are now, and we take appropriate
I feel like the
action, and we
algos
took
picked
that
up on
appropriate
that
action
for a
today.
second, but that's your third little pop that led to a drop, so be careful. I still think it's the same
Thanks,
analysis
Howard
from
Schneider
when we
with
opened.
Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates. right? And markets has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You know, you see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
Changing character, if you.
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Bro, literally from that fucking comment.
Hi, Stephanie Rule, MSNBC.
The market baked in
Treasury
cuts.
Secretary Scott Bessent has said that the Federal Reserve
and predictable
suffers
overcount.
from mission creep and
that was all here, because like I'm saying.
bloat. He's now calling for an independent review.
Fuck
Would
you
you support
guys.
an independent review?
Fuck
or
all
are
of
you
you.
open
I
to
don't
any
care,
sort of
Republican or Democrat, dude. 3 questions on Fed independence is bullshit. He just said they only do 50 basis points if they expect something, and they did that before the election last year. We never got these questions. That's when Fed independence happened. This is bullshit. So what happened here, he literally said predictable overcount. That was a really big credibility question, and he said it was an overcount. So think about it. If he's not worried about labor now, do they think today is overcounted? And then he said the market baked in the cuts and pretty much said he got pressured into it, and then we ripped. And then this lady's back with the independence question. But fuck all of these reporters asking that. That's such a bad question. That's why I'm saying that. It doesn't help anybody. It's just political jargon to just repeat and repeat and repeat when the issue of independence was a year ago. And he just gave us more evidence of that. So, yeah.
At the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that. And I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college, and yeah, there may be something there. It may be that companies
staples.
or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things, but yeah, it's probably a factor. Hard to say how big it is.
It's not for clickbait. It's brainwashing you guys into thinking there's
Thanks,
fucking
Mr. Chairman.
Fed independence
What,
issue.
what
that
evidence do
started
you
today,
see
not
of
last year.
tariffs showing up in inflation?
Well, if you can take goods, just sort of
Trump
the broad
tweet.
goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail, or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is, it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have
Bitch,
nothing
he's gone.
new on that
He's
for
gone
you
in
today.
February. What do you mean? It's February, he's replaced by May. He needs to leave now.
Hi, Katerina Saraiva with
Jeez.
Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being
What
helped.
about the lady with the crazy eyes that was on
and
the
that
Fed?
person is still employed by the White House.
Shut up, big forehead.
How can markets and the public interpret, some of
That's the fourth time, bro. Just
his
dumb
speeches,
shit.
for example,
What
and
about
then some
Lael
of
Brainerd?
the
You remember
forecasts
her?
that we see today. I mean, the median
And then they took her out and
for
put her into
this
another
year was
government
moved,
post. The fuck are you saying?
because of the introduction of his forecast. I'm
I
talking
know
about
she
the
got
number of,
brain in there.
rate cuts
How come
seen
she's
this
not
year.
using it? I see the side.
What
You
do
see what I'm saying?
what
I
do
see
you
the
say
window.
to markets and the public that are trying to
How come she's
interpret,
not using it?
what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and your
On the
one's
data
understanding
that
of the
you know
economy.
is
That's really all that
predictably
matters.
wrong.
And that's how it's going to work. And
And then you said you're not doing anything because of
I think
data.
that is the way the institution.
It's all the
that's
risk
in the DNA
management?
of the institution. That's
I
not
wrote
gonna
it
change.
down, sir.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message?
What do you think, bitch?
Our response is we're going to do everything we can to
Are you
use
asking
our
me?
tools to achieve the goals that Congress has given
You
us.
spend more on interest
and we're
in the
not gonna
military.
Get distracted by anything. So I think that's what we're going to do. We're just going to keep
How?
doing our jobs.
Why?
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting,
All right,
I think there
I'm
was
too
a
poor to
lot
comment
less
on this one. This
dissent
sounds way too
today
eloquent,
than a lot
guys.
of people
Sorry.
expected.
I'm gonna sit this
It'd
one
be
out.
good to know
Claire's
just what you
hella
think the
eloquent
drivers were
and
of coming to that
sophisticated.
very strong consensus in the meeting, and Also on the flip side,
I'm
to
sure
just
she
explain
doesn't hate
why the
freedom. We'll see.
plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide
I want to know if you and Mark Cuban have the same stylist,
that,
baby girl.
The situation has changed with respect to the labor
All right,
market.
you're right back up to
Whereas
second
we could
candle.
still say,
I
and
have
did
the,
say
the
in
comments,
July,
that same
at the
one,
time of the July
predictable
meeting,
overcount.
that the labor market
And
was
then
in
Powell
solid
getting
condition,
forced.
and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls.
Yeah, the bonds aren't with it.
Other things as well suggests that
And the
there really
dollar's
is
up.
meaningful downside risk. I said there was
That's
downside
the part
risk
I don't
then,
like.
but I think that downside risk is now a reality, and there's clearly more downside risk. So I think I think that's broadly accepted, and so that meant different things for different people. Some wrote down, almost everyone wrote down.
You just said downside risk is a
supported this
reality
cut.
of the jobs market,
And,
but you spent the whole speech
some supported
downplaying it.
more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think
this was one
like
of
I
his
said,
worst, bro.
Very unsurprising given
There's a
the
lot of
quite unusual, historically
what the fuck?
unusual nature of the challenges that we
Everything
face.
still remains though.
But
Next couple
let's
of weeks.
remember
but
though, the unemployment rate's 4.3%.
I mean, his
The economy's
messaging is
growing
very, very
at
poor and
1.5%.
diluted now.
So
it just doesn't even hit the same for me. But
it's not
even
a
the
bad
market,
economy or anything like that. We've seen much more challenging economic
feel bad
times, but
'cause I
from
like
a
him,
policy
but
standpoint, the
just
standpoint
doesn't
of
make
what
sense.
we're trying to accomplish,
And he's gonna go
it's
at the last
challenging
minute.
to know
That is what he said.
what to do. There are,
but
as
we
I
already knew
mentioned
that.
earlier, there are no risk-free
It's the
paths
same thing
now.
as under Biden, bro.
It's not
Unfortunately.
incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum
Look, he's telling
employment.
you, he just
those
told
are
you how
two
much they don't
equal
care about
goals.
inflation.
And
But then
you
every
will
time he
see
says the
that
labor
there are
market's
just
weak, he'll
a
tell you
range
it's
of
not as
views
weak, just how he does
on
with
what to
everything
do.
else.
Nonetheless, we came together
But usually
today
he's
at the
not
meeting
adding
and,
an extra
and,
cut
uh,
and cutting
acted
when
with
he says
a
this.
high degree of unity.
Thank you, Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the
Barron?
break-even rate is.
Oh, Arch.
So there
What?
are many different ways to calculate it, and
swear that
none
was
of them
Barry
is
Trump.
perfect. But it's clearly come way
Fucking Archie.
down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last
But then
2
he
or 3
just
years.
blamed it
So
all
we're
on
not getting that
immigration.
now.
That's
We're
why the
also-
market's-
we've got much lower demand.
You're not getting a
it's
real message on
interesting,
labor right
that
now. It's very
supply
odd.
and demand have really come down
Because you
together
thought it was
so
really
far.
weak coming into
Except
today.
now we do
all
have
did.
unemployment
But he
ticking
gave you
up
10 different reasons.
outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
We just
May, you mentioned
he's
the
just
downside risk
acknowledging the
point
intention.
amount, but it's
But he hasn't really
striking
said
that measures
shit.
of kind of activity and
Everything
output for the third
over here
quarter, those that we
lied.
have, seem pretty strong. The Atlanta Fed's GDP
Now
now
let's
is
wait
very
for
strong. Yeah, you mentioned strong
reaction over
PCE
there.
numbers as well.
If I
How do you
see
square those
potential
things? Is there a chance to actually cut the
compound
upside risk
trade,
to the labor
which is
market
I
if
have
those
planning
activity
for.
measures are right?
Well, that would be great. We'd love that to happen. So I don't know
taker
that
is
you see
fully
a big
maxed
tension
almost,
there, but
30
it's
second, 1 minute.
gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So, we watch all of it, and I would say we did move up.
He
The
does- dude, he
median
is
for
different
growth
today.
for this year actually moved up
He just doesn't.
in the SEP
He
between
seems sad,
June and September.
But I think checked out would be a better
SEPs. So,
better answer.
and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that
He
were the
just
focus
said
of
everybody.
today's decision.
What was he? He said job caught everyone's attention, but then he's saying it's really just the risk.
Hi,
'Cause then
Nicole
he blamed it on
Goodkind with Barron's.
immigration.
Thank you for taking
But
my
then the
question.
college demand
Given
is
the
so odd.
cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and
First
potentially
question on
hindering
housing.
household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity.
It is.
So it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did
REITs
that.
got knocked.
The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy, that's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up, during the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual, and so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that.
Ain't saying shit.
They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable and
There's
stable
only 40
prices,
minutes
so
left. It's probably
that
going to
should
end
help.
in like 10 minutes.
This rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate, and I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities, and I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations.
Yeah, right now, the only winner is
You
China.
mentioned at the short run
China's the only thing
gone
doing
up a
good
little
unless
bit. I wonder if you can
IWM and
talk
REITs come
a
back.
bit about that.
Now
And then
Netflix
also at
is
the
running.
long run, wondering, do you see evidence that the debate over Fed independence and the growing
Oh my fucking
is putting
God!
pressure on inflation expectations?
This is why I should not say anything.
So
I'm about to go
as
off
you,
on all
as
of
you
them.
said, shorter-term inflation
is what I was-
expectations have tended to
propaganda.
respond to near-term inflation.
Get
So
real
if inflation
journalists
goes up,
in there who will ask a real
inflation
question.
expectations will predict that it takes just a little while to get back down. Fortunately, throughout this this period, longer-term inflation expectations,
God it's the
both
last
break even in the markets and
fucking
almost all of the
snakes.
longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of
Oh yeah, Michigan.
running at levels that are consistent with 2% inflation.
he
over
called
time.
Michigan
So
an outlier,
We
thank
don't
God.
take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest
Yeah, we're
rates.
not.
Thanks very much.
Thank you. Well, that was odd because again, you guys saw how it played out. We got the extra rate cut, which again, all of a sudden, Powell and the Fed, they're like, yeah, we're down with more rate cuts. They cut the rates. They say the economy is going to be stronger. They expect inflation to go up. But here's what you guys got to realize. Remember what I was telling you leading into this. We were all saying it's time to move on. Why did the rate cuts get credible? Because the job market was going down. And everybody knew it. And it was bad. That the negative revision, the big revision, other factors, again, even AI and other things you've already seen. So people were talking about the jobs market. Even Powell acknowledged, he said it. So he said, risk is labor going down. Downside risk is a reality. Labor market risks have grown. Labor is weak, but he's saying it's cooling. He used, I kept calling it out in the beginning, every way to describe labor, he described it way better than we all thought. We all thought it would be really bad. That's why we were getting the rate cut. But then he keeps saying it's cooling, edging. And then throughout the speech, he would say, yeah, the risk is a reality. It's big, jobs. Risk is labor going down. But then he said, well, it's only because of immigration. But then he keeps bringing up supply and demand, and then they're like, well, if it's because of immigration, your rate cut doesn't do anything. Think about it. So if you're cutting because of the labor market, but then the labor market's being impacted and you're saying primarily by immigration, the fuck do you mean? Then why is the rate cut credible? It's not. Then why would you want to cut more next month? You see what I'm saying? That was the issue. The description of labor weakness was much different than everybody expected. That I could say. And that's where, like, he kind of went back and forth on it. But then there was this first pop, right? Not here, but right here. This is when he said inflation outburst is a risk, but it's not that bad anymore. And now it's about the labor market. So he said the inflation outburst risk for tariffs, it dropped. But then he says now the labor market risk is there. That's why we popped and dropped. And then here, right where we bounced, it was two things. First, he said they asked him about the job revision. They were asking him about the credibility of in a different sense. But they were saying they're like 900 jobs revised. Doesn't that, think about it. You're talking labor, all of these things. How does that factor into it? So he said there was a predictable overcount. And then he brought up the birth-death model, but he's saying that it didn't really surprise them. And then that's where we started popping. And then in the second candle of it, he was saying, well, yeah, the market was already pricing in cuts. And he kind of just made it sound like he reacted because that's what was priced in. PayPal to partner with Google Cloud. I think that's coming out right now. But yeah, so the real way, I think an extra rate cut is good. Yeah, that's working. That's real. Look at PayPal. It kind of already faded 2%. You're a little bit behind on that one. I don't think I'm going to play it, but watch. Google PayPal partnership. But yeah, the real problem of this, you got an extra rate cut. Our path is decent, but now I don't think you have a clear path forward because all of the reasons he explained didn't really make sense. So like I'm saying, if you next time you think a rate cut because of labor, I don't know if he's going to blame it on immigration or if it's actually weak. I don't know if that's going to be a move for risk management or is it because he's actually reacting. So unfortunately, that labor market weakness got a little bit of doubt, but now inflation. I don't think we're really worried about inflation. Like I was telling you, with the cut before he spoke, if inflation credibility data or anything got bad, that would kill all of this. But he just said that the inflation outburst risk has been lowered. They're not as worried about that anymore, which I never was. I was worried about one burst, but really not that much. But yeah, now they're down with that. But the labor market thing and viewing the cuts as recessionary or not, that's what I was telling you guys at the beginning. And he said they're going to react at the last moment, man. If this is all like a risk management cut, then the whole idea is to get involved right when they think it's not risk management. So unfortunately, Powell's not going to say the right thing until it's too late or at the last second. But this is why I was telling you guys, recession or not, think about it. Think about what he just said. Oh, we're doing it for risk. We don't think inflation will come back up. It's very simple. 2 months, 3 months. If inflation comes back up, we're fucked. Labor market drops a lot. you're really fucked. And if it doesn't, we're going to rip. That's it. I mean, that's how I'm viewing it. But yeah, maybe it's too simple. Either way, we're back up to holding the bull rally. We did think the extra cut was dovish, but that credibility remains, man. Yeah, start the clock for sure. I definitely would moving forward. And I don't like bonds. I don't like a stronger dollar. So the equities are going up, and they're kind of reacting dovish, but the things underneath the surface are not dovish. Dollar and TLT, they're giving you a different one. So either way, Chattadunia, I'd wrap it up. You got 30 minutes left. I think that was a very interesting POW. Everything I said in the beginning, though, still remains. I'm still excited. Like I'm saying, I'd start the clock. But we can't really look for Powell as the North Star anymore, unfortunately. You know, True North, we just talked about it, but I just don't think Powell he's gonna tell you at the last second, unfortunately, because that was just a little bit of everything. They're chalking it up to risk management again. And yeah, you got many, many reasons. A little bit of confidence on inflation, but not much, because remember, they raised their inflation target. So even though he said what he said about the outburst, their target is still high. It's still 2 years to get to 2%. So unfortunately, here we are. Yeah, just like Biden, he's still waiting. He did the same under Biden.
So let's check out what's happening in the market. It was a crazy speech by Jerome. Gonna turn on my colleagues also on Discord so they can give their commentary also on what's going on in the market and where their view are. It's very important to have different views by different traders, right? And to give you the insights which you need to understand the market, having different views so you can build your own view about the markets. So basically the market drops and then pumped, and right now we're expecting that exactly, and as I have drawn on my chart, and was very expected, right? So we have done that perfectly. So the path forward is going to be interesting. And second of all, the dollar over here is increasing, getting strength, and I think is going to increase more, which is going to weaken the equity side. So the money is flowing in the equity into the dollar index, right? And the same for Bitcoin. Bitcoin is more risky assets and so on. We will be analyzing it in deeper, but TLT itself has dropped and the volatility is dropping, which is very crazy when it's coming to that because when TLT is dropping and VIX is dropping, usually in the market pumps. And while that was happening, right, the market was dropping also, kind of. So oil remaining almost the same. Gold dropped and had some volatility in it, so the market wasn't sure what to do. And we are at the downside parallel channel, at the bottom of that parallel channel. So let's look at the 4-hourly side. So we are over here, and I could expect a correction to 112 and 11 over here and break it to the downsides. But let's look at first over here. We had a couple of support at that level also, and this is a good support, so I would expect to go higher from here to that level over here to 118, and watching it very carefully over here, because I'm right now in a hedge position on crypto, and my hedge is going against me in the crypto space, as we can see it over here in the bubble chart. How the market is moving is not that bearish reaction on that fake Jerome Powell speech, which was very confusing and confused all of us what the direction the market's gonna go. But one thing which I have noticed while watching it, let's go to the 4-hourly over here. The manufacturing, the producer manufacturing was dropping. So the producer manufacturing is which is one of key indicator also for the PMI, the producer manufacturing, producer managing index, and also the services is also two of them. Is building the sector overview, the services. 80% we are manufacturing and 20% services. Doesn't mean that is the services is less important, but both of them were dropping, and when it's dropping, this is having effect on the PMI. And the PMI is a leading indicator which the Fed used to manipulate the market, and what I mean by manipulate, change the direction. So they step in based on those indicators, the PMI, the CPI, the inflation, the GDP, and the real GDP, and the yield curve, to tell where the market direction is going to be and what to do next steps. And that's being said, when the producer manufacturing stocks is going low and consumer services, so it is very important the units is being produced and the services unit is being served to look at those numbers. But currently, if it's dropping, maybe the market's seeing something what's going to happen in the future, eventually forcing the Fed decision to cut even more into this year, a second cut or even a third cut when the numbers is worsening. That's being said, I just watching that, I just want to make sure that over here my view is still bullish on crypto. One last leg to the upside before downside over here. And that's being said, let's do that. And also the dollar index over here is just perfectly double bottom going upside, and equity sides is still remaining unknown. Is it going to go higher, lower? And especially on those hours 30 minutes before the close, the market always pumps. So I wouldn't look for any shorts over here. Always 30 minutes before the market closed, there is a pump on ES, so because money is moving out of the market, right? So we got an alert over here. This is a meta alert. This is going to hell, and kind of going to hell, and was not expecting that, because I was expecting for higher prices, as had shown some significant move from here. Some people bought it, but kind of is losing its steam also. So I'm waiting for reaction over there also and checking it out. Second of all, let me ask a couple of my friends over here in Discord, which we have their live stream through whole our live stream. They were streaming also with us. Arthur, are you here? So, Shipley, anyone here?
But I think the next couple of weeks, you're going to see if that
I would assume
deniable or
the colleagues are right now off charts. So what we have covered today is very important to keep it in mind. We said I am right now building this program for you. If you are interested, leave a comment that I am interested. I want to learn more about the journey of real trader and how to become more serious trader and independent one who is thinking independently, and what you're gonna get, and most importantly what those 12 weeks process is and how is this gonna be, and also about myself, who I am and what I'm doing. The most importantly, the transparency hub, which I have built to give you the most transparency education ever in the whole finance industry. No one will be doing the same as I have done over here, and you will never find it somewhere else. The most important is to understand over here, I publish on a weekly level my journal, what's going on with my journal over here. And second of all is to understand the weekly journal and the monthly, and how my performance is and how my compliance, my own rules, and a couple of other certification and proof I have over here. And second thing was my newly developed red flag index, and to how to score education in the financial industry or overall education based on the transparency, guarantee, clarity, capacity, delivery, risk, marketing ethics, so pricing and so on. You can then download it straightforward. They have done a couple of analysis also for you to figure out which one is the best for you without any hard feeling. As I said, I'm taking only 5 people this quarter, and after that it will be remaining 5 people to keep the quality very high and give you really something useful, and which is working with your own personality. Yeah, of course. That's being said, don't forget to follow me on LinkedIn, because I have over there a couple of stuff posting on a daily basis, such as my daily dose of news, which I'm posting on a daily level the top headline market before the bill stock to watch analyst recommendation, and a couple of other things from key economics events, company reporting results, ex dividends, and overall sentiment in the market. And that's being said, go over there, give me a follow, give me a like, and don't forget to also to hit the bell button on YouTube, so it will support me to reach my voice more people who are in need of those analysis, which is truthworthy and honesty. That's being said, thank you very much for being today here and watching with me the Fed decision and taking the time and the effort to listen all those hours with me, and you have done a great job becoming a more independent trader over time. And see you the next time with a new live stream, new stock market ideas. And one last time, the direction for the market is unclear. Bitcoin, I'm looking for more upside, and the XY telling us it's gonna go higher, which is gonna weaken equity markets. And yeah, so looking very curious and cautious about the market. So I will be probably de-hedging my hedge. Currently, I'm in the crypto space based on the bubble chart. Is nothing changing. So they are moving higher, so I will be closing my hedges over here. I got some positive hedges, but some of them are negative, so we will be not needing that in necessity. Again, thank you. Don't forget to leave a like, comment, and a follow over on YouTube too. See you next time.